Hey, good morning, everybody. My name is Brian. I am the president of Fundamental Research Corp, and thank you for joining us in today's webinar, Intro to Investing. So before we get started, just a couple of disclaimers and disclosures. Um, this webinar is for educational purposes only. It's not financial, investment, tax, or legal advice. Every investor's situation is unique, and we encourage you to consult with a professional that knows your specific situation. We're not here to give investment recommendations. Any stocks mentioned in this presentation are solely for example purposes. We're not endorsing them, and those companies are not endorsing us. Um, Anytime we talk about results, there's no guarantee that it's going to repeat in the future. It's historical, and we engage in issuer paid research, which means that companies can pay us for analyst coverage. Okay, so the agenda for today? I know there's a lot of different people with varying backgrounds and knowledge levels, but I really want to start from the core. So I'm going to go over who we are. Before we started the webinar, we surveyed people what were their main concerns or what do they want to take away from this. So the two things were people didn't know where to start and they didn't know how to value stocks. So we're going to take care of all of that in this presentation. We're going to start with the foundation for what I believe is the most important thing to understand. And a lot of you might think it's basic, but we're going to review it because I think it's very crucial to understand the economy and the market and the environment we live in. Then we're going to move on to two basic frameworks for stock selection. So there's thousands of stocks out there. How do you actually narrow down the options? Um, we're going to talk about using a stock screener. Then we're going to go into basic accounting concepts, basic finance, and the fair value. And we're going to use Apple as an example, just because everyone knows this company. And then we're going to show you how you can do all of this in under 10 seconds. And then we'll open it up for Q&A. So if you look in the bar at the bottom of your screen, there should be a Q&A button. You can feel free to send questions at any time, but I will get to them at the end of the presentation. So let's get started. Okay, who are we? So we've been around since 2003. The whole concept is we didn't want to be the 40th analyst covering Walmart. So there's tons of analysts covering these large caps out there. So we wanted to focus on under-followed companies, small and micro cap companies. Since then, we've evolved into a platform where our mission is to basically provide institutional grade tools for every investor. The platform that we designed is designed to be a one-stop for stock analysis. So when I was doing research, I had many screens open, many different programs. I'd be pulling information from a lot of different sources. I wanted it all in one convenient place, and that's really how we designed the platform. So it's how we would want to use it. And you'll see later when we talk about fair value, we're giving investors access to the same model that we're using to allocate our own capital. So why fundamental analysis? There's two main schools of thought in how to analyze stocks. One is called fundamental analysis and one is called technical analysis. Technical analysis involves using charts to try to recognize patterns. And fundamental analysis approaches it as a business. So when you're investing in a stock, you are actually investing in a business. So to us, if you're a longer term investor, that makes more sense because you want to take the time to understand the business, what economic factors are going to affect that business. So it's important to understand the concepts that we're going to go through in this presentation to be able to carry that out. A lot of people like technical analysis. It's easier. But in life, easier is not always better, right? So if you take the time to understand basic business concepts, I think in the long run, it's more effective. Some key features of our platform, we're going to be constantly rolling out new features, but the first one that I think is really useful are the fair value estimates. So we have fair value estimates on thousands of stocks. And it's based on a concept called discount cash flow. And it's the same method that we use to allocate the firm's capital. And we've now made it available to all investors. The second is we provide institutional quality research on small and micro cap companies. When I first started in the business, I wanted to access analyst reports on companies, and I found it very difficult to access them because you would have to have accounts at all these brokerage firms or banks in order for them to allow you to access the research. So we want to make that type of research available widely. Um, Another feature of our site is our curated portfolios. So these are the two main ones we have right now are our top picks. And these are companies that we cover that our analysts have the strongest conviction on. And historically, they have outperformed their benchmarks over various time periods. They tend to be smaller and higher risk companies. So you should be aware of that. The second portfolio, which we just launched, is called the Model Picks portfolio. So these are 10 sectors. There's 11 major sectors in the overall stock market. We've excluded the financial sector. Um, but for all the other sectors, we've used our fair value model to try to find the two most undervalued companies in each sector. And then the profiles that you're going to see later in this presentation were designed so that if you're interested in a stock, you'll be able to analyze it all in one spot. So let's get started. Um, the basic foundation of everything is economics. So we live and operate in a market-based economy. So it's important to understand what affects all these the economy. So number two is supply and demand, which we're going to go over. I'm sure you've heard of it. We'll quickly go over it as a refresher. And then I'm going to show you how economics can be useful for analyzing almost anything in daily life, not just financial or business topics, but pretty much any situation. We use economics as a framework to understand different industries, and we're going to go through an example of that shortly. And then, of course, stock prices move in response to supply and demand, which is why we're here to study. So the basic concept, if you remember from Econ 101, is this graph. So very quickly, if this was a market for apples, what it's showing you on this horizontal axis is how many apples are supplied at various price points. So, for example, if apples were $100 a pound, and by the way, I just made these numbers up, they don't reflect the real world. But if apples were $100 a pound, demand for them would be virtually zero. So that's why this demand line is downward sloping. If the price was zero, people would demand 100 pounds of apples. So that is just common sense, right? The supply curve is the opposite of that. At $0, farmers wouldn't want to produce any apples because why would you if you're not getting paid for them, right? But if the price was $100 a pound, then farmers would be willing to supply 100 pounds. So let's look at what happens when apples are $100 a pound. So farmers would want to supply this much, but people would only want to buy this much. So there would be a surplus of apples in the market. And the only way for there to correct this surplus is the price needs to fall to $50, at which point demand would equal supply. And the opposite is true too. So if the price were, let's take an extreme zero, demand would be here, supply would be here. So in order, that would be a shortage. There's too much demand and not enough supply. So the price needs to go up and reach this equilibrium point. So this is a very simplistic version, but this is the basic model of how our economy operates, and it's the basis for everything else in the economy. Of course, it's not perfect, but compared to other methods of economies, I think it's the best one.
Note on economic theory and seatbelts. The following seatbelt and knives example is a hypothetical academic thought experiment used to illustrate the idea of moral hazard, that people adjust their behavior based on perceived risks/costs. It is an extreme model intended to show how economic principles can be applied broadly to analyze situations beyond monetary or financial issues. It is not a suggestion for real-world policy or how to drive. In practice, safety is a collective activity. The choices of one driver can affect many. If one driver chooses protection while others don't, the unprotected are at a catastrophic disadvantage. Always wear a seatbelt and follow traffic laws. Seatbelts remain the most effective tool for saving lives and reducing the severity of accidents. Bottom line, the theory can be used to explain why people drive the way they do, but the law and common sense dictate that seatbelts save lives. Wear one.
And let's move on to real world applications. So if you think of everything as costs and prices, we can take seatbelts as an example. So this is a non-financial use of economics, and it will just demonstrate the power of these concepts. This was actually told to me by an economics professor in university. So, and it stuck with me because I think it's really interesting. So the professor posed this scenario. Do you think seatbelts actually increase accidents or decrease the amount of accidents? So the thought process goes like this. So the what does a seatbelt do? The seatbelt decreases the cost of having an accident, right? So if you get in an accident and you're wearing a seatbelt, you don't go through the front windshield. So that is lowering the cost of having an accident. If you don't have the seatbelt and you get in an accident, the cost of accident increases. So if we look at the supply and demand curve that we previously discussed, when the cost of something goes down, the demand for it goes up. So of course there's no demand for accident because nobody wants an accident. But what it's saying is when the cost of having the accident decreases, the number of accidents actually increases. So to visualize this concept, he went to an extreme case. He said, what would cause people to drive more carefully? Having seatbelts or sticking a knife in the steering column and not wearing a seatbelt. So if you think about it, if you drive around with a knife in your steering column and you have an accident, it will increase the cost of having an accident dramatically. So you will drive extremely carefully, right? So in theory, the number of accidents should go down. So, this is obviously a hypothetical situation, but you can see how applying economic concepts can be useful in daily life, just to think about different policies when governments are proposing different policies, or you're talking about, society with your friends, you can approach it from this perspective. Let's look at an actual more useful example. So coffee shops. So imagine a small town and there's an individual there. We'll call that person John. So John lives in a small town with zero coffee shops. And John takes a trip to Italy and notices coffee culture everywhere. So John says, I can take this back to my town and I think it would work. This is something that people would want. So he opens a coffee shop in his small town and it takes off. It's popular. People line out the door, right? So what happens in this situation? Another enterprising individual drives by the coffee shop, sees the line out the door, and says, wow, John is making a fortune with this coffee shop. I am also going to open a coffee shop. So this individual, number two, opens a coffee shop in the small town. So now what happens? So now that line, maybe half go to the second coffee shop, half stay with John. Third person drives by, sees coffee shops popping up everywhere, lines out the door. This person also opens a coffee shop. Now we have three, and let's say there's no more line. So now, how does the market operate? So now with no line, the three coffee shops need to compete for customers. So they're going to have to give better service in order to attract customers from each other. They're going to maybe compete on price, quality of the product. But you can see all these things benefit the consumer, right? So if they're competing on price, the price will come down. That is a benefit to the consumer. If they have to provide you better service to attract your business, that benefits the consumer. So in that kind of free market, that is a net benefit to the consumer. And it also allocates capital in a way that is efficient. Because let's say a fourth coffee shop open and there's not enough people anymore in that town to patronize all the coffee shops. So one of them will have to close. And the one that might close is maybe the one with not as good service, maybe their pricing is too high, their product is no good, right? And then we're back to three, and then it's operating in optimal situation. So again, theoretical example, but that's how economics can be used to think about industries. So if you want to analyze semiconductors or oil or grocery store stocks, you can use kind of that economic framework um, to do that. So with stock prices, they're moving according to supply and demand. As news comes into the market, people adjust their expectations of what that stock is worth, and the price adjusts. And one thing to note is that stock prices are forward looking. So the key to investing successfully is to be able to predict what is going to happen in the future. So, having said that, how do you narrow down what stocks to buy? So there's thousands. So there's two basic frameworks for stock selection. One is called top down and one is bottom up. So top down is you start with a view of the entire world and you say, okay, 2026, which economy do I think will do the best? And then let's say you say, okay, the United States. So you focus your attention on finding companies in the US. Then you say within the US, what companies or what industries do I think will do the best? So then let's say you think it's tech. So now you've narrowed it down further. And then within tech, what's going to do well? Then you say maybe AI. And then within AI, who's going to do the best? Okay, semiconductors. Then you say, okay, who are producing semiconductors? Then you analyze which are the best ones, and then you try to pick the winner. So that's top down. So bottom up is opposite. You don't start with a worldview. You just start with, I want to find undervalued companies. I don't really care what industry they're in, as long as they're undervalued. So that's really the two ways of stock selection. So what I want to show you guys is on our site, we have a screener that can help with this method of narrowing down the companies. So for example, if you click fair value, you can screen based on all companies, top undervalued, high growth. So we're going to leave it on top undervalued. And then let's say you're only interested in NASDAQ listed companies, you would hit add. And then just like we discussed, let's say you're only interested in semiconductor companies, then you would hit add. And then the screener returns all the companies that meet your criteria. And you can sort these by, say, upside potential. So, for example, the screener is telling us that Skyworks Solutions is currently priced at 56.25, but our algorithm is putting a fair value estimate on it of 311.53 for a potential 462% upside. So that is not saying that's going to happen. So what you need to do now is further analyze why this is the case. And I'm going to show you how to do that and run through some scenarios in a second. But for now, that is how you can narrow down. So a lot of the people that said they don't know where to start with finding stocks, you can start with the filter. And then you can start thinking about what method you makes sense to you, whether you want to start at the top and filter down or start at the bottom and kind of filter up. So what we're gonna do now is go over some basic accounting principles because it is fundamental analysis. So we have to understand business. The language of business is accounting, so it's very important to understand. We're going to go through an income statement, a balance sheet, and a cash flow statement. And you're going to be able to understand after this what you're looking at. Just so I'm using Apple, as I mentioned. The first financial statement you need to understand is called the income statement. So what this is it's over a time period. So in this case, it's a year. And it's for the year ended September 27, 2025. Most companies have a calendar year ends like December. Apple has a September year end, but it's important to note that. It's also important to note this number in millions. So if you look at, so the income statement is basically a profit and loss statement. If you've heard the term bottom line, it tells you how much profit, sales, expenses, profit Apple made within the year. So it's in millions. So what does that mean? In for the year ended September 27, 2025, Apple sold 307 billion dollars worth of products. So it's in millions because you need to add six zeros after this. It's just to save space. So it's not they sold $300,000 worth of product. It's $300 billion worth of products. And then services, so subscriptions, 109 billion. So total sales were 400 billion. So what I like to do here is just look at the trend. Is it increasing? Is it decreasing? Obviously, you want it to be increasing. The next is their cost of sales. So it costs them 190. Let's just say it's all iPhones. I know they have other products, but let's make the conversation simpler. So they spent 194 billion building iPhones and they sold them for 307 billion. So that's called the gross profit. When you subtract what they sold them for from the cost of selling them, you have this gross margin, 195 billion. That's what's left over after paying all their suppliers. So the company making the glass for the iPhone, the case, the internal components, whatever, that's what's left over. From this 195 billion, Apple invested 34 billion in research and development. So developing their next iPhone, other AI initiatives, whatever. Then they spent 27 billion on selling general and admin. These are salaries, rent, marketing, things of that nature. So in total, their operating costs were 62 billion. So from this 195, they spent 62, and you come up with operating income of 133 billion. And then they pay taxes, 20 billion. And then if you've heard the term bottom line, this is it. So that's the profit left over after all end of the day selling iPhones and other products. And this number is what the shareholders are entitled to. So when you buy a share in Apple, you own a piece of Apple. And so each share is technically allocated a portion of this profit. So they don't pay it out as a dividend. They can pay it out as a dividend, but most companies reinvest that cash into their business. And we'll go over those concepts more later. But that's why this earnings per share number is so important and why analysts pay so much attention to it and other investors is because when there's a certain number of shares outstanding for Apple. So in Apple's case, it's 14 billion shares outstanding. And let's say you buy one share, then technically of this one share, you are allocated $7.50 of this profit, right? And we'll go through it more in detail later, but that's the profit and loss statement. The next statement that is important to understand is the balance sheet. So this shows you the position of Apple at one point in time. So the other statement, the income statement, was how much they made in a year. This basically shows you their financial position in one point in time. So why is it called a balance sheet? The easiest way to think of it is like a house. So let's say you buy a house for $100. That would be an asset. So it would list here asset, house, $100. The second part of the balance sheet tells you how that house was financed. So let's say you put $50 down and you borrowed $50 mortgage from the bank to buy the house. So it would show on your balance sheet a liability of $50 owed to the bank and equity $50, what you own of the house. So when you total the loan from the bank and the equity you put in, 100, it should equal the value of the asset. Okay. So that's basically to simplify how you can think of the balance sheet. The thing you need to be cognizant about is that this is based on a mixture of historical values and current values. So accounting is not always cash based, and I'll explain what that means later on. But that's essentially what you are looking at when you look at Apple's balance sheet. So what's important here are current assets. These are assets that they expect to be converted into cash within a year. So cash is cash. So they have 35 billion on their balance sheet. They have 18 billion in securities. They have 39 billion in accounts receivable. So that can be like they've sold an iPhone and you don't have to pay for 30 days. So they're expecting people to pay them. Inventory, this is how many iPhones are, or the dollar value of iPhones sitting in a warehouse somewhere. Then you have longer term assets like factories. And then on the other side, it tells you how those assets were financed. So you have some debt, maybe you have accounts payable, and then you have shareholders' equity. So the last statement that I want to talk about is for finance people, this is the most important statement. Okay. So this is called the cash flow statement. And I mentioned earlier that the other two statements are based on accounting concepts that might not be actual cash. And so this will kind of make it more clear. So the three main components of a cash flow statement. So again, the cash flow statement is over a period of time. So over a year, and then September 27, 2025, how much cash did Apple generate? And then again, the scale is in millions. So from operating activities, which is the first part of a cash flow statement, Apple generated $111 billion. That's actual cash coming into the company. So why might it be different than what's shown here? We're showing they sold 416 billion and their profit was 112 billion. So why might it be different? Because I might have sold an iPhone and you don't have to pay me for 30 days. So I report it as a sale. So it would show up on the income statement, but no cash is actually coming into my pocket. And at the end of the day, that's the most important, right? Is cash. So this shows you the actual cash coming into the company because I sold that iPhone and let's say I gave the person 30 days to pay, and what if they don't pay me? So then it's useless. I've lost money. But this shows you the actual amount of cash that came in. So that's why it's important. And that's why for finance, we look at these numbers. The other number that's important is the investing activities. So this tells you basically the number that you want here is this payments for acquisition of property, plant, and equipment. So this is usually what we refer to as capital expenditures. So this cash that Apple is generating is not on a perpetual machine, right? So in order to continue generating this cash and for it to grow in the future, Apple needs to continuously invest in its factories, maybe maintain the factory, grow, add capacity to the factory. So this cash is not free, right? Because you're having to reinvest in it. It's kind of like if you pictured you start a business, let's say you buy a hot dog cart and you selling hot dogs on the street and you're generating a certain amount of cash from those hot dog sales, but you have to maintain the cart too. And so if you just look at the cash coming in, it doesn't tell the whole picture because you need to consider, well, what do they need to maintain that? So that is the basic three accounting statements that are important to know and understand. And now we go into analyzing them. So we have ratios, we have time series analysis, and we have comparables analysis. So time series analysis, I'm going to skip ratios and come back because you'll see what I mean later on. But excuse me, time series analysis is basically looking over the years. So I alluded to this earlier. You want to see their sales growing over time. And if they're not, you want to know why. And if they are, you also want to know why. Comparables analysis is basically comparing Apple's financial performance to other phone manufacturers or other similar companies. So if I'm comparing maybe Apple and Samsung, let's say Samsung has a 50% gross margin and Apple has a 40% gross margin. So I want to understand why. They're both selling phones, but why is one able to generate more gross profit than the other? Maybe Samsung is using cheaper materials. Maybe Samsung is able to price their phones higher. Maybe, so there's many factors, right? So you always want to look at comparables because if you just look at one company on its own, it might look good, but then when you compare it to another company in the same industry, then maybe it doesn't look so good. Ratios are basically taking those numbers from the financial statements and expressing them as a percentage. It's important because let's say I have $100 in sales of iPhones, and then it cost me $30 to buy the glass and the components in order to make the phone. So my gross margin is 100 minus 30. I have 70 left over. So my gross margin is 70%, right? Let's say the next year I go to $200 of iPhone sales, but my cost to produce them is 100. So now my gross profit is 50, and the gross profit is 50 divided by 225%. So it actually, even though the sales increased on an absolute basis from 100 to 200, the percentage that I'm keeping after selling each phone has gone down. So that's why it's important to do the ratio analysis. And I'm going to show you how to quickly do that with our platform later on. Okay, the last basic concepts that you need to understand to invest are finance concepts. The first one is risk versus return. So in general, you need to take the higher the risk of an investment, the higher expected return. And so, in order to understand this, you need to understand the concept of the risk-free rate. So, the risk-free rate is usually established by US government T-bills. So, the US government borrows money just like everyone else. And what they say is, give me $100 today, lend me $100 today. And let's say they say, in 1 year, I will pay you back $103. So the interest rate is 3%, right? And so the chance of the US government not paying you back is close to zero. It's probably zero, but nothing is certain, right? So it's as close to zero as you can get. So that is considered the risk-free rate because if you lend the US government money, it's risk-free essentially. So now let's look at a stock. And let's say you use our fair value model and it's telling you the expected return on this stock is also 3%. So you have two choices. You invest your $100 in the stock and get 3% expected, or you lend it to the US government and they give you 103 next year guaranteed. Nobody would take the risky investment because why, right? Um, so the risky investment needs to return more than the risk-free rate. So that risk-free rate kind of sets a benchmark. So let's say this risky stock, the expected return was now 5%. And you look at it and you say, well, is the extra 2% worth the risk that I might lose everything? Probably not. So then what does this risky investment have to return in order to be attractive relative to the risk-free rate? So that is something you need to determine on your own. But historically, stocks in the long run have returned between 8 to 10%. So you can see what investors kind of expect to be compensated for over the risk-free rate. The next concept is the time value of money. So a dollar today is worth more than a dollar tomorrow. If I told you to give me, you can have $100 today or $100 tomorrow, you would take it today. Why? Because if you take it today, you can invest it at 3% risk-free at a minimum. So it's worth 103 next year. So if I said, I'm going to give you $100 next year, it's not of value to you because you can invest that $100 today in a T-bill, get 103 next year, right? So um, money has what's called a time value. So with how we apply this to stocks is what we're trying to do with fundamental analysis is project the cash flows that a company is producing into the future and trying to determine how much that is worth today. And that's essentially what the fair value model is doing. So the third concept, free cash flow, that's what we're trying to predict. And that's what I discussed earlier in the Apple financials when I was discussing the cash flow statement. And I said, you have to look at how much cash is coming in, how much cash they're generating, but also how much they're needing to reinvest in order to maintain that cash and grow it. So that's what's called free cash flow. So the concept of free cash flow is when a company is generating cash, not all of it can be returned to the shareholders because, as we mentioned earlier, part of that money needs to be reinvested in the business. Once they've set aside that money to reinvest in the business, what's left over can now be generated or distributed to the shareholders because you can distribute that money back to the owners of the company without affecting the growth of the company. If I distribute all the money, my factories will start to deteriorate. That's a simplified logic behind it. So I can only distribute what's left after I take care of the company. So that is the concept of free cash flow. So it's not to say that the company is going to give you that money, but in theory, that is what you are entitled to when you buy a stock. And so that is the value driving the stock. Okay, so now that we have that concept, we're trying to project the cash flows, free cash flows into the future in order to value the company. You have to understand the concept of discount cash flow, which is easy because I already told you that the money has a time value. So when we project, let's say, the free cash flows of Apple out 5, 10 years, the cash flows 10 years from now are not worth the same as the cash flows today because money today is worth more than money in the future. So what I need to do is take that 10-year expected cash flow that I think Apple's going to generate and bring it back to what's called the present value, and come up with how much is that 10-year cash flow worth today. And so we'll go into how you actually do that in a deeper class, but we have the tool online for you to be able to do this. The second way that you can value stock is what's called comparables. So these are the two main ways to determine fair value. One is discount cash flow, and the second is comparables. And we like to use both because they serve as checks on each other. In order to do this, I'm going to go through an example for you of how a house purchase. Let's say you're wanting to invest in a home for investment purposes and you're going to rent it out, okay? So you have house A and you have house B. House A is selling for $100. House B is selling for 75. If you only look at the price, you might conclude that home B is cheaper. And this translates into why you shouldn't just look at a stock price and say, this one is trading at 100, this one is 50, so the 50 is cheaper. That's not the case for many reasons. One is I'm going to show you this PE calculation. But two is you don't know how many shares are outstanding. So we'll go over this in a future class, but just for now, know that a $50 stock is not cheaper than a $100 stock. It is cheaper in absolute terms, but in terms of valuation, you can't just determine it in that manner. So home A, let's say, is expected to generate rental income of $10 a year, and home B is going to generate rental income of $5 a year. So what you need to do is divide the price by the income. So in this case, you get a PE. This is what we refer to as a PE of 10 times. So home A is selling for 10 times income. Home B is selling for 15 times income. So if you look at this, home A was more expensive, but on a relative basis, it's actually cheaper because you will get your money back in 10 years, whereas in home B, it will take you 15 years to get your money back. So that's why we calculate a PE with stocks. So for the stocks, the way you calculate the PE is you take the stock price and you divide it by the earnings per share, which we discussed in the accounting section. And that's kind of, the income that you're entitled to. And then you can compare which stock is actually cheaper based on the PE. Okay. So now that we've gone through all the basic concepts, we can go through an actual example of how to analyze a company. So we use the stock screener, which I showed you earlier, and let's say that it returned one of the companies that returned was Apple. So now what we can do is use this tool on our site. You just click here, put in Apple or whatever stock you're interested in, and you'll get this page, the company profile page. But this is how we designed everything for you to be able to analyze the company all in one page. You don't need to go to many different sources. So the first thing I would like to look at is usually the market cap. This is the total value of all the shares outstanding. So in theory, if I wanted to take over the whole company, I would pay $4 trillion for it. The overview is really important. Just, everyone knows Apple, but if you're looking at a company that maybe you've never heard of, this will tell you, okay, what do they do? What industry are they in? I like to look at the stock price over time just because I want to understand if it's been going up, if it's been going down, and then I want to know why. Why is that the case? So I mentioned earlier in the call, we're doing fundamental analysis. We're not looking at patterns and charts, but it's important to look at just the stock price because you want to understand overall how has the stock been doing. We also do we have an AI feature where you can hit this, why is it moving? So what we've done is the model will pull information from all different sources and try to synthesize why the stock is reacting the way it is today. So with AI, we think it's a very valuable tool in order to gather and synthesize a lot of information that a human could not possibly do. But it's just a supplement to our own analysis. And the reason is we don't know where the AI is getting its data from. We don't know if it's clean. We don't know if it's made up. The AI model can also what's called hallucinate, where it gives you wrong information. And then we don't know what model the AI is using to look at the world, right? So we discussed earlier, we're using a supply and demand market-based model, discount cash flow. So it's a very useful tool, but I would not rely on it entirely. The next section shows any research that our analysts have done on the company, the past research we've done, um, the stock quote, which is what the stock traded at its high today, at its low, what the 52-week range is of the stock, the trading volume. And then we go into the ratios. So this is something that is really important and that I touched on earlier, but let's go into more depth now in how to use this. So I mentioned why it's so important to calculate the margin, not just look at the absolute numbers. So this shows you the profit margin trend over time. So Apple's net margin has gone from 25% in 2022 to 26.9% by 2025. So the trend is in general up. So every dollar that they're generating in sales, they're keeping more of it. So that is a good indication. So that's what I like to look at is the profit margin trends over time. Um, these are return metrics. So the key ones here are return on equity and return on assets. This shows you how well management is deploying the capital in the company. So if you start to see this number ROE dropping over time, then maybe for every dollar that they're reinvesting in the company, they're not able to generate as high a return for investors, and they should start thinking about returning some of that money to investors in the form of a dividend. We can go through this in more detail later, but these are what these metrics are telling you. This one is very important. It's the valuation multiples over time. It's essentially what we just went over with the housing example. This tells you how much investors are willing to pay for each dollar of earnings. So in Apple's case, it looks like over time, investors have been willing to pay more and more. So in 2022, the PE was 24.4. In 2025, it was 34.1. So stock prices can go up either because the earnings go up or people are just willing to pay more for each dollar of earnings, which seems to be the case here with Apple. What you can also use this for is if you see, for example, that historically it's traded at a PE of, let's say, around 27, and one day the PE drops to 20, that might indicate that it's a good buy at the moment. But you have to look at why did it drop. If it's a temporary thing, for example, let's say some geopolitical conflict somewhere in the world, all stocks drop that day. And from history, we know that these situations, while they're bad, they tend to be temporary, right? So the conflict resolves and then the stocks start to go up again. So if the PE drops because of you think is temporary situation, it might be a good time to buy. On the other hand, if it dropped because let's say the situation is more permanent, then it might indicate that it's cheap for a reason. So an example would be people stop using printers. And so the stock drops and it looks cheap, but if people don't start using printers again in the future, then it's going to stay cheap. The last is the liquidity ratios. So these are balance sheet items, and it just shows you how much debt the company is using. So in general, you want to see debt to equity declining, right? So debt in and of itself is not bad because it's tax deductible. You get something called leverage, right? If you can borrow at 3% and invest at 10, you're getting leverage. You're using somebody else's capital to generate a return. So companies that have debt are not necessarily bad. It's when it gets too much as a proportion of what they can pay or relative to equity that it becomes bad. Um, then we have the dividend analysis. So it tells you how much dividend they're paying, what the yield is. So the yield is basically for every dollar that you're investing in Apple, it's paying out 0.42% as a dividend. Earnings analysis is also important. It shows you what analysts were expecting each quarter and what they actually reported. So in general, when companies surprise the market, the stock tends to go up. And if we look at go back to the economic section, the supply and demand, I mentioned that stocks are forward looking, right? So when there's a surprise, and it's not what people expect and it's positive, then the stock tends to go up. And of course, the news. Then this fair value section is what I think saves you a lot of time. Because in order to calculate the discount cash flow and the fair value, historically, we would gather all the financial data historically, put it into a spreadsheet, analyze it, run the model. And so now we just automated it for all the stocks, thousands of stocks. So you can see the current price is 254. Our fair value algorithm is calculating 158, 37% downside risk. So now you shouldn't blindly trust this, but it's a good reference point. And then you can look further into why is it like this. And again, the key to investing is being forward looking. So let's say that you believe that they're going to launch a new iPhone next year and that there's some feature that is going to make the sales take off. And maybe it's not being reflected, and other people don't have that view. If you turn out to be right and everyone else is wrong, then you would you would make money by investing. So the key is to use all of these as a reference point and then come up with your own interpretation of the data. The next parts show you more financials, comparable companies. So, like I mentioned, it's important to compare the company you're looking at to other similar companies. The institutional ownership, this shows you whether large investors are on average accumulating the stock or selling. It's just a good indication of what larger investors who might have access or know, like, more powerful analysis are doing. Insider trading, this shows you whether insiders, people that work at Apple management team, are net buyers of the stock or net sellers. Again, it's similar to the institutional data where the theory is that if you work there, you might know some things that indicate to you that it might be a good time to buy or sell. So you have to take all of this information and apply it. Okay, so to wrap up, determining fair value, quick checklist. Check the fair value on our website. Is it overvalued? Is it indicating that it's undervalued? Use the screener to narrow down your choices. AI is very useful, but don't rely on it. Are the margins of the company that you're looking at increasing or decreasing? Do they have acceptable debt levels? Are their sales and profit trending up, down, flat? And the key is always why, right? So know what the trend is and why. Free cash flow, is it positive? Is it negative? Um, Comparables, and then do they pay a dividend? So I want to thank all of you for joining us on the call today. We are going to be sending out some emails with follow-up survey, feedback on what topics you'd like to see in the future. Also, everyone who attended will get complimentary basic access to our website so that you can practice the concepts that we've learned. Thank you guys for attending our presentation today, and we hope you found it useful.